Imagine you woke up one morning with $100,000 burning a hole in your investment account. You want to put it to work, not for a quick flip, but for real, sustainable growth over the next 20 years. Which ETF do you choose? Today, we're going head-to-head. SCHD versus QQQ versus JEPI. And we're going to simulate what happens over 2 decades. Let's start with the fundamentals of each strategy. SCHD, Schwab U.S. Dividend Equity ETF, focuses on high-quality dividend-paying U.S. companies. It tracks a dividend-weighted index and selects firms with strong balance sheets, consistent cash flow, and sustainable dividends. SCHD's long-term average annual return since inception is around 12.04%. Its expense ratio is extremely low, just 0.06%. That combination makes SCHD a favorite for investors who want both yield and capital appreciation. The fund holds around 100 stocks, carefully selected through a rules-based approach that emphasizes dividend sustainability and quality metrics. Then there's QQQ, the Invesco ETF that tracks the NASDAQ 100. This fund is essentially a bet on technology and innovation. It's heavily exposed to tech giants like Apple, Microsoft, Amazon, and Google. QQQ offers high growth potential, though with more volatility. Its expense ratio is about 0.20%. Because of its tech-heavy exposure, QQQ has historically outperformed many broad market ETFs during bull markets, but it's also taken deep hits in downturns. The concentration in the top 10 holdings means that a handful of companies drive most of the returns, which can be both powerful and risky. Finally, there's JEPI, the JP Morgan Equity Premium Income ETF, launched in May 2020. It uses a covered call strategy combined with high-quality equities to generate monthly income. It's designed to provide current income with some potential for capital appreciation. Its expense ratio is relatively higher, around 0.35%. The payoff? JEPI yields consistently, offering a smoother stream of cash flow, but its growth will be capped by the options it sells. The fund actively manages both its equity holdings and option overlay, making it more hands-on than traditional passive index funds. Now let's set some assumptions for our 20-year simulation. We'll begin with a starting principal of $100,000, assume dividends are reinvested for SCHD and QQQ, while JEPIs are partially reinvested. We'll also assume no additional contributions. This is a pure lump sum test. Based on historical performance and forward-looking expectations, SCHD can reasonably be modeled at 10% annualized returns, QQQ at 12%, and JEPI at 7% when combining yield and moderate growth. If you invest $100,000 in SCHD and let it compound at 10% annually with full dividend reinvestment, by year 5 it grows to around $161,000. By year 10, roughly $259,000. By year 15, about $418,000, and by year 20, approximately $673,000. That's more than a 6-fold increase, a strong combination of dividend compounding and capital appreciation. The beauty of this approach is that those dividends keep growing year after year, creating a snowball effect that accelerates wealth building over time. With QQQ, assuming 12% annualized returns and reinvestment, by year 5 your investment grows to $176,000, by year 10 $311,000, by year 15 $552,000, and by year 20 around $979,000. Under that growth scenario, your $100,000 nearly becomes $1 million. That's the power of compounding in tech-driven innovation. The higher growth rate may seem modest compared to SCHD, but over 2 decades, that extra 2% makes an enormous difference in final wealth. JEPI, with a 7% annualized total return, compounds more modestly. After 5 years, $100,000 becomes about $140,000. After 10 years, around $196,000. After 15, $274,000, and by year 20, roughly $382,000. The difference is that JEPI's income stream pays you monthly. For investors relying on cash flow, that consistent distribution can be a huge benefit, even if the overall growth is slower. Over those 20 years, you could have collected more than $150,000 in distributions, which represents real cash that many investors use to fund their lifestyle or reinvest strategically. Each fund carries its own distinct personality. SCHD balances growth and income beautifully. It's composed of quality companies with strong fundamentals, offering steady dividends that can grow over time. It's a favorite among long-term investors who want to see reliable compounding without the wild volatility of tech stocks. The fund's focus on dividend aristocrats means you're investing in companies with proven track records of shareholder-friendly policies. QQQ, in contrast, is an adrenaline rush for your portfolio, highly rewarding but also capable of testing your nerves. It's concentrated in tech and innovation, meaning that during bull markets, QQQ can explode in value. However, it's also prone to sharp drawdowns. Those who've stayed invested through downturns have been rewarded handsomely, but timing mistakes can cost you dearly. The psychological challenge of watching your portfolio swing 20 to 30% in months can't be underestimated. JEPI plays a different game altogether. It's for the investor who wants to generate income, now. By writing covered calls, JEPI effectively trades some of its future growth potential for present-day cash flow. This makes it ideal for those nearing or in retirement, where the focus shifts from building wealth to maintaining lifestyle through steady income. The monthly payment schedule aligns perfectly with how most people manage their expenses, creating predictability. Let's discuss taxes and cash flow. SCHD and QQQ dividends are typically qualified, which means they're taxed at favorable long-term rates. JEPI, however, generates much of its income from option premiums, typically taxed as ordinary income, which can be higher. This makes JEPI more tax-efficient when held in accounts like IRAs or 401ks, while SCHD and QQQ can be more flexible across taxable and tax-advantaged accounts. Understanding these tax implications can save you thousands over a 20-year period. When it comes to cash flow, JEPI stands out. Investors often use it to fund monthly expenses or reinvest part of its income. SCHD and QQQ, meanwhile, build wealth through compounding. Reinvested dividends and growth appreciation are their engines. In the long term, reinvestment of dividends makes a profound difference. Even modest dividend yields, when compounded over decades, contribute significantly to total return. What's surprising is how compounding trumps yield alone. JEPI might pay you every month, but SCHD and QQQ's reinvested dividends could easily outgrow JEPI's total value over time. Volatility, often seen as a risk, can actually be an ally in growth-focused funds, like QQQ, provided you stay invested. Market dips allow reinvested dividends to buy more shares at lower prices, boosting long-term compounding through dollar-cost averaging. However, for income investors, consistency often outweighs compounding. JEPI's smoother returns and regular payouts can help prevent panic selling during downturns. Behavioral finance plays a huge role here. Many investors stick to their plan more reliably when they see consistent income, even if total returns are lower. This behavioral advantage often translates into better real-world results than theoretical projections suggest. Now, let's compare how each fits different investor profiles. If you're in your 30s or early 40s with a long time horizon and appetite for growth, QQQ's potential to nearly 10 times your money in 20 years makes it extremely compelling. For those in their 40s or 50s looking for balance, SCHD offers the perfect middle ground. Solid returns, lower volatility, and growing dividends that can eventually replace income. For retirees or income-focused investors, JEPI delivers peace of mind with its monthly cash flow and reduced downside risk. Risk can never be ignored. SCHD's risks revolve around dividend sustainability. Companies can cut dividends in recessions. QQQ's risks are tied to its concentration in high-growth tech. Regulation or valuation corrections can hit hard. JEPI's risk is opportunity cost. In roaring bull markets, it lags behind because its covered calls cap upside. Each ETF is shaped by a different philosophy, so diversification across them may actually be the best solution for most investors. Imagine a portfolio split evenly. 1/3 SCHD, 1/3 QQQ, 1/3 JEPI. The SCHD portion gives dividend growth, QQQ fuels capital appreciation, and JEPI provides cash flow stability. Together, they form a diversified engine that can perform well across different market cycles. This blended approach reduces the risk of being overly concentrated in any single investment philosophy while capturing unique benefits. It's also crucial to note the impact of fees. Over 20 years, even a 0.3% difference in expense ratios compounds into thousands of dollars. SCHD's 0.06% expense ratio gives it a massive efficiency advantage over the long term. QQQ's 0.20% is reasonable for its performance, while JEPI's 0.35% is on the higher side, justified somewhat by the active management and option strategy. On a $100,000 investment over 20 years, these fee differences could mean tens of thousands in final wealth. When you model how these ETFs behave under real-world economic cycles, the best ETF for you depends not only on returns, but on how you experience those returns. During the 2008 financial crisis, dividend-paying stocks recovered faster. Companies that maintained or raised dividends acted like a lighthouse in the fog. The Nasdaq fell almost 50%, but investors who stayed invested caught one of the greatest bull markets in history. In 2020, the pandemic sent QQQ crashing 30% in weeks, but it skyrocketed soon after, as tech became the backbone of lockdown life. QQQ doubled within a year if you stayed invested. SCHD fell less sharply and continued paying dividends. JEPI's income strategy would have kept monthly payouts coming, allowing investors to reinvest when everything felt uncertain. Each strategy provided a different kind of psychological comfort during that unprecedented moment in market history. In 2022, rising interest rates slammed tech valuations. QQQ dropped nearly 30% while JEPI barely blinked. SCHD quietly outperformed both thanks to its defensive dividend stocks. This highlights a key insight. The winner changes with the environment. Over 20 years, all three have a place. QQQ shines when innovation leads. SCHD shines when fundamentals matter. JEPI shines when markets chop sideways and volatility spikes. This cyclical outperformance teaches us a timeless investing truth. There's no single ETF that wins all the time, but the one you can stick with will always win over time. Consistency beats perfection. That's why a balanced approach, owning a mix of SCHD, QQQ, and JEPI, often outperforms the investor who jumps from one to the next chasing performance. The psychological stability of a diversified approach keeps you invested. Most investors overestimate how much timing matters and underestimate how much time matters. If you missed the 10 best days in QQQ over the past 20 years, your return would have dropped by nearly half. If you missed the 10 worst days, you'd be rich. But no one can predict them. The better plan? Stay invested through both. This is why buy and hold investing continues to outperform active trading for the vast majority of investors. Let's shift to psychology. Investing isn't just math. It's emotion, behavior, and discipline. The ETF you choose must fit your temperament. QQQ requires emotional resilience. Watching a $100,000 investment fall to $60,000 in a tech crash and still holding, that's not easy. SCHD offers comfort during those periods because dividends still arrive even when prices drop. That dividend check becomes a psychological anchor. JEPI takes that further, offering monthly income that smooths the ride. Behavioral economists call this the income illusion, when steady cash flow feels like progress, even if your portfolio's total value temporarily declines. It's not a bad thing. In fact, it's one of the reasons income strategies help people stay invested. If your ETF pays you every month, you're less likely to panic sell. This behavioral edge often matters more than theoretical return advantages in the real world. Let's talk about real-world outcomes. If you had invested $100,000 in SCHD 20 years ago and reinvested every dividend, your annual dividend income today would likely exceed $10,000. That's a 10% yield on cost, a reflection of years of dividend growth. QQQ's dividend yield remains tiny, but your capital appreciation dwarfs it. JEPI might still hover near that original investment size, but it could have paid you $5,000 to $7,000 per year in cash flow the entire time. Suppose your goal is to live off investment income starting at age 65. Using today's yields, SCHD pays around 3.5%, JEPI around 8 to 10%, and QQQ less than 1%. That means $1 million in SCHD might pay you $35,000 per year, JEPI $80,000 plus, and QQQ just $10,000 unless you sell shares. The catch? SCHD and QQQ will likely keep growing, increasing income potential each year, while JEPI's payouts might stagnate if markets flatten. Taxes play another silent but massive role. Dividend income from SCHD and QQQ is mostly qualified, meaning it's taxed at lower rates. JEPI's option income is usually ordinary income, which can reduce after-tax yield in taxable accounts. That's why many financial advisors suggest holding JEPI in tax-sheltered accounts like IRAS, while keeping SCHD or QQQ in taxable ones for better efficiency. There's also inflation to consider. Over 20 years, inflation quietly erodes purchasing power. Growth ETFs like QQQ act as inflation hedges because the underlying companies can raise prices and grow faster than inflation. SCHD companies also tend to increase dividends annually, protecting your income's real value. JEPI may lag because covered call income doesn't naturally adjust for inflation. That's another reason to blend strategies for comprehensive protection. Behavioral discipline remains the silent driver of returns. Many investors lose more to emotional decision-making than to fees or volatility. The temptation to sell QQQ after a crash or chase yield with JEPI can erode long-term results. Consistency and patience always win the compounding game. When researchers analyze real investor behavior, they find something shocking. The average investor earns 3 to 4% less than the funds they own simply because of emotional decisions. So, who wins after 20 years? Statistically, QQQ likely produces the highest final balance at around $979,000. SCHD's combination of income, growth, and low cost creates the most livable wealth at approximately $673,000. JEPI remains the quiet enabler at $382,000, the one that gives financial confidence through cash flow, even when markets misbehave. The smartest move? Don't treat this as a contest. Treat it as a construction project. Build your wealth like an engineer. SCHD as the foundation, QQQ as the steel frame, JEPI as the finishing layer. Together, they form a portfolio that can endure recessions, reward patience, and support your life for decades to come. At the end of the day, $100,000 is just the starting line. The real question is, how much of it will still be invested when the next crash hits? The investor who masters patience and discipline will find that whether it's SCHD, QQQ, or JEPI, the path to freedom isn't about predicting markets, it's about staying the course through every twist and turn. If this helped you rethink your ETF strategy, hit the like button, share this with someone building their portfolio, and subscribe for more deep dives into investing logic, long-term wealth design, and the psychology behind money. Because at the end of 20 years, it won't be about which ETF won, it'll be about whether you did.